I want you to start off by visualizing something for a second. Picture pulling out your phone, authenticating your banking app, and looking at your total net worth.
Which for most people is a pretty stressful experience.
Oh, absolutely. But instead of that familiar, subtle tightening in your chest or calculating your cash flow runways or just feeling that low-level hum of anxiety, you just feel total, absolute peace.
Wow. Yeah. That's a rare feeling.
Pure autonomy, right?
Yeah.
You look at that number and think, this fortress is solid. I am completely secure.
And that is an incredibly rare psychological state in today's world.
It really is. And if we're deeply honest, most of us are operating like light years away from it.
We are, but I mean, it's rare because the entire architecture of the modern consumer economy is explicitly engineered to prevent you from ever achieving that state.
So it's not a mistake.
Not at all. You aren't failing at this by accident. You are functioning exactly as the system designed you to.
That is a terrifying thought, honestly.
It is, and that frames the core thesis of the source text we are analyzing today. We're looking at excerpts from Financial Özgürlüğün ve Servet İnşası'nın 10 temel kuralı, which translates to the 10 fundamental rules of financial freedom and wealth building.
Okay, let's unpack this. Because our mission for this deep dive is to strip away all that deliberate obfuscation of the finance industry.
Right, the jargon that just confuses everyone.
Exactly. We're getting down to the unglamorous, violently simple, and often psychologically uncomfortable mechanics of capital accumulation.
And the foundational premise we have to accept right out of the gate is that being financially normal is a catastrophic trap.
Normal is broken.
Yeah, completely. Society's normal dictates remaining on this high-velocity treadmill of consumption until you are physically forced to retire.
And just praying the state infrastructure can catch you.
Exactly. This text isn't a manual for optimizing that next line. It's a blueprint for becoming wildly, systematically abnormal.
So to achieve that abnormality, we have to fundamentally alter the flow of capital through our lives.
Which requires overriding what the text identifies as lifestyle inflation. Now, everyone knows the cliche, spend less than you earn.
Right, the oldest advice in the book.
But the actual mechanics of lifestyle inflation are incredibly insidious. When your income scales up, say, a promotion or a major client acquisition, your consumption baseline instantly expands to absorb the new liquidity.
Like gas expanding to fill a room.
Perfectly said. A perfectly functional vehicle suddenly needs to be a luxury lease. Standard leisure becomes, premium experiences.
The socioeconomic signaling just demands that your spending scales proportionally with your earning.
Yes. But the source uses a very specific mathematical example here. If you generate 100,000 lira in monthly income, you must deliberately cap your consumption infrastructure as if you only generate, say, 75,000.
Right.
That 25,000 lira difference isn't just savings. It's your only lever for systemic wealth creation.
But let me challenge the feasibility of avoiding that, because we exist in a hyperinflationary, high-pressure society.
We do, yeah.
When your peer group is scaling their lifestyle, resisting that isn't just a math problem, is it? It's social isolation.
It feels very lonely.
It's like being on a treadmill. Every time you get a raise, someone just turns up the speed of the belt. You're running faster, but you're staying in the exact same place financially.
Which is exactly why the source argues that wealth is exclusively built in the gap between ego and income.
I love that phrase, the gap between ego and income.
It's brilliant. And this isn't about extreme frugality or, living in a cave. It's the mechanical difference between intentional capital allocation and automatic consumption.
Because automatic consumption just drains your liquidity to maintain a socially dictated facade.
Exactly. So you enforce that gap, you isolate the capital. But the immediate failure point for most people is letting that capital sit idle.
Right, because they are waiting for optimal market conditions. They want the perfect time to invest.
What's fascinating here is the brutal asymmetry of time in the compounding equation. We all intellectually understand compound growth, but people fundamentally misprice the cost of delay.
How so?
Well, the source outlines a 25-year-old deploying a fixed monthly tranche of capital into a broad market vehicle versus a 35-year-old executing the exact same strategy.
Doing the exact same thing just 10 years later.
Exactly. And by age 65, the earlier allocator has captured 2 to 3 times more total wealth.
That is just wild to think about. Even though the 35-year-old deployed the exact same amount of capital month over month for 30 years.
The late starter didn't take less risk. They didn't generate less yield. They just missed the highest velocity compounding window.
So that 10-year hesitation mathematically costs hundreds of thousands, if not millions, in terminal value.
It does. The illusion of the perfect entry point is arguably the most expensive psychological trap in finance. Perfect time is always in the rearview mirror.
Okay, but even if you optimize the gap and leverage time perfectly, none of it matters if your own biology overrides your strategy during a macro shock.
Yes, the biological factor.
Let's talk about the reality of market crashes. Because theory is clean, and reality is incredibly messy.
Very messy.
When a massive deleveraging event happens, like the 2008 crisis, and you watch your net worth evaporate by 40% in real time, the biological urge is to liquidate and flee to cash.
It's pure evolutionary wiring. The text dives deep into the biological mechanics of loss aversion here.
Which is what, exactly?
Well, the neural pathways in the human brain that process acute physical pain are the exact same pathways that process economic loss.
Wait, really? The exact same pathway?
Yes, we are evolutionarily optimized to avoid danger, not to patiently hold out for abstract future gains.
So when the market drops, our brain treats it like a physical attack.
Exactly. So the psychological agony of seeing your portfolio drop by 1,000 lira is registered as roughly twice as intense as the dopamine hit of gaining 1,000 lira.
That is deeply unfair.
It is. The instincts that kept your ancestors alive on the savannah are actively sabotaging your portfolio.
So how can we possibly fight thousands of years of evolution that wires us to run from danger? I mean, if the market is actively tanking, plunging 40% into a recessionary spiral, isn't doing nothing, just passively watching your wealth burn.
Well, people feel that way, sure.
How does the text mathematically justify not liquidating assets to protect capital and then, just buying back in when valuations are lower?
Because, that strategy assumes you possess perfect foresight and frictionless execution, which no human actually has.
Right. None of us have a crystal ball.
The text is definitive on this. Liquidating during a panic converts a temporary, unrealized drop in paper valuation into a permanent, mathematically locked-in loss.
You just cement the damage.
Yes. Millions of investors capitulated at the absolute bottom of the 2008 crash, moving to cash to feel safe.
And they entirely missed the recovery.
They missed the historic, decade-long bull run that immediately followed. You cannot outsmart your own panic in real time.
So what's the answer? Acknowledge the fear and do what?
Build a system. The solution is preemptive system design. You must architect your investment strategy so that the panicked, emotionally compromised version of yourself cannot easily access the sell button.
Here's where it gets really interesting, because the text highlights that it's not just the trauma of losing that destroys capital, it's the arrogance of winning.
Oh, absolutely. Overconfidence is a killer.
The illusion that complexity somehow correlates with higher returns. There's a brilliant case study in the source about a retail investor named Davoud.
Yes, Davoud's story is such a classic example.
He enters the market, allocates capital to a single equity he researched, and he hits a massive early win.
Which is, ironically, the most destructive sequence of events for a novice investor.
Because now his brain is flooded with dopamine, right? He attributes a macro market movement to his own personal genius.
Of course he does.
He starts viewing the equity market not as a wealth-building mechanism, but as a casino. He's day trading, reacting to news cycles, attempting to time sector rotations.
He genuinely believes his frantic activity is producing alpha.
But the reality of his execution over a 5-year horizon tells a devastating story. The text deconstructs Davoud's actual net yield.
And it is not pretty.
Not at all.
Oh.
Once you factor in the relentless friction of his strategy, the bid-ask spreads, the broker commissions, the massive tax drag from short-term capital gains, and just the statistical inevitability of mistiming trades, his portfolio radically underperforms.
Had he simply allocated his initial capital to a passive, broad market index, absorbed the market beta, and done literally nothing for 5 years, his terminal wealth would have been significantly higher.
It's the paradox of effort in finance. Doing more actively results in less wealth.
But the entire financial services industry monetizes the illusion of complexity. They need you to believe that wealth creation requires bespoke, convoluted instruments.
But the historical data is clear. The most dominant capital accumulation strategies are relentlessly, almost embarrassingly simple.
But simplicity requires profound discipline. It requires the ego death of admitting you cannot outtrade algorithmic models and macro forces.
Which is tough for a lot of people to swallow.
It is. True financial expertise isn't complex maneuvering, it is the absolute mastery of boring fundamentals.
Which perfectly transitions into the defensive infrastructure you need to survive. Because to survive those market crashes without panic selling like Davu, you need to build a defensive wall around your investments.
You need a fortress.
We've talked about capital allocation and psychological management, but none of that survives contact with reality if you haven't built a fortress around your wealth. And the foundation of that fortress is crushing destructive consumer debt.
Right. Now, obviously, wealthy people leverage debt constantly.
Yes, but the text draws a critical distinction here, doesn't it? Good debt versus bad debt.
Exactly. Strategic leverage to acquire cash-flowing assets or historically appreciating real estate is a wealth multiplier. That's good debt.
A mortgage on a reasonably priced home in a growing area, for example.
Right. Consumer credit debt, however, is a mathematically engineered wealth extraction tool. The source specifically targets high-interest revolving credit used to finance a bloated lifestyle.
Credit cards.
Credit cards. These instruments are meticulously calibrated by institutions to keep the consumer in a perpetual interest spiral.
But people justify it by looking at their investment yields. They think, well, I'm making 10% in the market, so I can float this balance.
And that is a fundamental arbitrage failure. You cannot systemically outinvest a 50% annualized interest burden on a credit card.
And the math just doesn't work.
It doesn't. If you are generating a 10% equity yield but bleeding 50% in credit servicing, your net wealth vector is massively negative.
They're drowning.
You are. The text is uncompromising here. Liquidating high-interest consumer debt isn't just paying bills. It is the highest yield, entirely risk-free capital allocation available to a retail investor.
Because paying that off is a guaranteed, risk-free, high-yield return.
You are instantly guaranteeing a 50% return purely by stopping the hemorrhage.
Okay, so once that bleeding is stopped, the text shifts to the cash reserve, the emergency fund.
Buffer.
Right. Now, everyone has heard the generic advice to stockpile 3 to 6 months of living expenses. People just nod at this advice and ignore it.
They do because it's boring.
But the source reveals the true purpose of this fund. It totally shifts the paradigm. It's not just a rainy day fund. It stops you from becoming a forced seller.
Yes. The concept of the forced seller is arguably the most critical defensive mechanic in the entire text.
Let's break that down.
Okay, let's look at the systemic risk. Say you have all your capital deployed in high-growth, long-term equities, and then a localized crisis hits you.
A catastrophic medical bill or, a sudden job termination, your car breaks down.
Exactly. If you lack liquid cash, you are forced to liquidate your long-term equity positions to cover that immediate liability.
And if that personal crisis happens to perfectly align with a macro market downturn, which they historically do, by the way, you are now selling premium assets at a 30 or 40% discount.
Exactly. You permanently destroy your future capital generation to solve a short-term liquidity crisis.
It's like an emergency fund is a financial bodyguard. It's not just there to pay the mechanic. Its actual job is to stand in front of your investment portfolio and take the bullet so your wealth can keep growing.
I love that bodyguard analogy. But let me anticipate the counter-argument here. Because many investors argue that holding a large cash position in a high-inflation environment is a guaranteed loss of purchasing power.
That's exactly where my mind was going. How is holding depreciating fiat currency a shield?
It's a deliberate, calculated loss to prevent a catastrophic one.
Oh, okay.
The text acknowledges that inflation erodes the cash buffer. You accept that negative real yield because the function of that money isn't capital appreciation. Its function is liquidity.
The bodyguard again.
Exactly. It acts as the financial bodyguard. It takes the bullet of inflation and localized emergencies so that your actual wealth-generating engines can compound uninterrupted for decades.
But having a bodyguard and avoiding bad debt requires a staggering level of psychological endurance.
It's exhausting.
You're asking someone to intentionally cap their lifestyle, absorb the inflation drag on their cash reserves, ignore the dopamine hits of active trading, and aggressively pay down debt. How do you maintain that discipline without feeling totally miserable?
This is where the mathematical mechanics cross over into financial philosophy. Money, absent a defined, concrete purpose, is nothing more than digital accounting.
It's just a number on a screen.
Right. The text stresses that accumulating capital merely for the sake of hoarding will inevitably lead to behavioral fatigue.
You'll just burn out and buy a sports car.
Exactly. The true wealth builders, the ones who successfully execute this decade-long strategy, they know exactly what job they have assigned to every single lira.
So Rule 8 is basically to clarify your purpose. It's the difference between abstract saving and targeted capital deployment.
Precisely. Their purpose is hyper-specific. Maybe the capital is assigned to secure an early exit from a toxic corporate environment or retiring at 60 to travel.
Or to permanently break a generational cycle of financial instability for their kids.
Exactly. When you anchor your strategy to a crystal clear objective, declining a luxury upgrade or an overpriced dinner stops feeling like deprivation.
It becomes a conscious, empowering assertion of your actual priorities. It makes discipline feel like a conscious choice rather than a punishment.
You're saying no to the car so you can say yes to the freedom?
Right. But let's address the elephant in the room regarding the timeline. Because the compound growth models we discussed earlier rely heavily on decades of runway.
They do, yeah.
So what does this all mean for the listener who might be feeling behind? The listener who is, say, 45 or 50 years old.
The late starter.
Right. They're looking at this strategy, looking at the time they've lost to lifestyle inflation and debt, and feeling massive regret. They feel like the mathematics are fundamentally broken for them. Is it just too late?
The source speaks directly to this under the principle of progress over perfection. The author leans on the pragmatism of the famous proverb. You know, the one about the tree.
The best time to plant a tree was 20 years ago. The second best time is today.
Exactly. The systemic rules of wealth building, enforcing the gap, crushing destructive debt, shielding with liquidity, and deploying capital consistently, they don't have an expiration date.
The math remains entirely identical, only the calendar variables change.
Exactly. A late starter will undoubtedly need to execute with a higher degree of aggression. They may need to widen their income to expense gap significantly more than a 25-year-old.
Right. They have to play a bit of catch-up.
But the foundational architecture is exactly the same. The text vehemently warns against letting the psychological regret of past inefficiency justify current paralysis.
So the only mathematically irreversible error is continuing to do nothing.
Yes, you don't need a massive liquidity event to begin. You just need to execute the very next logical step in the framework.
Which really brings us to the ultimate synthesis of this entire text.
Yeah.
We've dissected the biological pitfalls, the defensive infrastructure, and the necessity of purpose. But the umbrella covering all of this is a fundamental shift in how we perceive time.
This is Rule 10. The final tenet is the requirement to think in decades, not days.
Which is so hard today.
It's incredibly hard. We operate in a technological ecosystem obsessed with instant gratification and microtransactions. You can watch global asset valuations tick up and down, red and green, millisecond by millisecond on your phone.
And the text identifies this real-time access as a profound psychological hazard.
A massive hazard. Because the human nervous system simply cannot process extreme short-term volatility without triggering those loss aversion panic responses we talked about earlier.
We just aren't built for it.
We aren't.
And when you look at the individuals who actually execute this successfully, none of these wealth builders are necessarily geniuses.
Not at all.
They aren't predicting market rotations or accessing secret insider knowledge. They were just fundamentally, profitably boring.
I agree completely. And they are simply willing to do the unglamorous, boring work consistently day in and day out without drama.
It's just about showing up and sticking to the plan.
This raises an important question, though. Or rather, it reveals the most empowering reality of the entire source text. Achieving financial freedom is fundamentally not a test of mathematical genius.
Right.
It is a test of character. It is a measure of your psychological resilience when the macro environment is collapsing in panic.
Wow, yeah.
It's a measure of your independence when your peer group is drowning in debt to finance a lifestyle facade. It demands the incredible emotional strength to look at instant gratification and confidently say, you know, not yet.
They just do the unglamorous work. Day in, day out, they widen the gap, deploy the capital, and violently refuse to dig up the seeds every time the economic weather changes.
And their ultimate net worth simply reflects the cumulative reward of that glorious, persistent boredom.
So let's step back and look at the blueprint we've just mapped out today. We started by dismantling the trap of societal normalcy, realizing that wealth is generated exclusively in the intentional gap between income and consumption.
Escaping that treadmill.
Exactly. We examined the ruthless asymmetry of time, proving that immediate execution always mathematically beats the illusion of perfect timing.
Start planting that tree today.
We exposed how our own evolutionary biology, our inherent loss aversion, tricks us into locking in losses during market panics, and how the arrogant pursuit of complex trading strategies usually just decimates our capital through friction and tax drag.
The Devoot effect.
We mapped the defensive perimeter, aggressively liquidating the engineered trap of consumer credit and accepting the inflation drag on a cash reserve to guarantee we never become forced sellers during a crisis.
building that bodyguard.
We grounded the entire operation in a hyper-specific purpose to turn discipline into empowerment, recognizing that the framework functions regardless of whether you start at 25 or 55.
Progress over perfection.
And ultimately, we embraced the profound psychological shift of abandoning the anxiety of days to harness the immense compounding power of decades.
Being wonderfully profitably boring.
Yes.
And, we've talked about money as a tool for security today, but consider this final thought to ponder that builds on the source. What if the ultimate luxury these boring habits buy isn't a larger house or a better car?
What else would it be?
What if the true final yield of all this discipline is the total, uncompromised ownership of your own time? What if every single lira you save isn't just a coin in a bank, but an hour of your future freedom bought back from the world?
An hour of your future freedom bought back. I love that. When you visualize opening that banking app like we did at the very beginning of this deep dive, and you feel that overwhelming rush of security, that is exactly what you're looking at.
It really is.
You aren't just looking at an accumulation of capital. You are looking at a ledger of your own autonomy. Thank you for joining us for this deep dive. We hope this analysis provides the exact framework you need to take that first unglamorous step today. Until next time.